So, good afternoon from London and from Paris to everyone, whatever their time of day, to everyone who has joined us in such large numbers from all over the world, Europe, MENA, Asia Pacific, Africa, the Americas. I'm Stuart MacDonald, and I am delighted to moderate this timely and authoritative webinar. It is the latest in distributed ledger technology, or DLT, and crypto assets investment experts, Aaro Capital's thought leadership series of educational webinars. Today's is entitled The Power of Portfolio Diversification in Bitcoin and Beyond, and it is organized by Aaro in partnership with highly regarded asset managers, TOBAM, widely known for their innovative approach. These webinars are designed for investment professionals to learn more about this fast-growing, often complex, and fast-maturing space, still often misunderstood, and the exciting, dare I say, the huge investment opportunities that it presents. Serious interest from serious players is coming into the space, from Fidelity to Goldman Sachs to sovereign wealth funds, and some of the world's most respected family offices and investment advisors. And Aaro Capital is the first player, to my knowledge, with a truly institutional quality multi-manager approach to it. This is a very research intensive as well as structured approach. And this is reflected in what we'll hear from Ankush Jain, Aaro's co-founder and chief investment officer. He'll be speaking about portfolio diversification beyond Bitcoin. But first, it is a real pleasure, an honor to be able to introduce you to Yves Choueifaty. Yves is founder and chief executive of TOBAM, the Paris headquartered asset manager with 10 billion under management in diversification strategies covering equities, fixed income, and multi-asset strategies, and an early mover since 2017 into the crypto space. Yves will share his thoughts about the investment case for Bitcoin and its use as a unique diversifier. Now, if you want a copy either of Yves' presentation or of Ankush's, they can be downloaded and are available if you contact Aaro or TOBAM afterwards. If you have any questions for the speakers, please put them into the chat section. The earlier in the presentations, the better. We'll try to address them in the time available. Now, here is the substance of this webinar. Let me pass you immediately to Yves. Yves, over to you.
Thank you very much. Hello, everybody. So I am Yves Choueifaty. I'm the founder of TOBAM. I'm going to share my screen with you. Please tell me whether you can see it. I hope you can see it. Okay. Let me tell you a bit about our journey into crypto. The first person who invested in the Bitcoin at TOBAM invested as early as 2013. TOBAM is a team of about 50 people. Among those 50 people, there are 21 mathematicians and engineers. And it's because of this population and that we were exposed to crypto very early. In 2013, the Bitcoin was not really an investment asset. It was really more like almost a gadget, something created by geeks for geeks. And we began exploring this universe in 2013. Very early, we started organizing what we used to call the TOBAM Bitcoin dinners from time to time. And during one of those dinners in 2016, I told my colleagues, there is one characteristic of the Bitcoin which is improving year after year. It is its liquidity. I told them, if this is going to continue, a time will come relatively soon at which even the very large investors at TOBAM would be able to consider an investment in the Bitcoin. And this is when we have decided to launch what we have called the Crypto Research Project. Crypto Research Project into which we have decided to allocate 2 full-time researchers. The first mission I gave those 2 guys was to write an investment thesis on the Bitcoin. After a few months of work, we finalized our investment thesis on the Bitcoin. We went to the French regulator. We introduced him to our, investment thesis. And after a couple of months of very constructive discussion with the regulator, they allowed us to launch the first open-ended fund invested in Bitcoin in the world. And this fund stayed the only open-ended fund invested in Bitcoin in the world until a couple of months ago, when some Canadian colleagues launched their own open-ended fund a couple of months ago. After that, we continued our research, and we launched different initiatives, but we are not going to talk about those other initiatives. So I am going to introduce to you our investment thesis on the Bitcoin. And but before doing so, I usually give a warning. So I'm going to give you 2 warnings before I start really the core of the presentation. The first warning, it is that we are going to discuss only the Bitcoin and not all the other crypto assets. Not that there are no interest in the others, not that they don't have investment thesis as well, but simply that their investment thesis is different from that of the Bitcoin. In order to give you some perspectives, the second largest crypto asset is Ethereum. Ethereum, in terms of duration of life, is only 1/3 of that of the Bitcoin. And the volumes on Ethereum are roughly 1/4 of those in the Bitcoin. I would like also to attract your attention on the chart of the price of the Bitcoin, which is represented here in a logarithmic scale, and which in my mind give you some perspective of the past behavior of the Bitcoin, of the price of the Bitcoin. The second warning is in fact a bad news. It is that the Bitcoin is an extremely risky asset. Until you own some Bitcoin, you have no idea of what is the risk of the Bitcoin. The risk of the Bitcoin is really one of its kind. There are no other assets which exhibit so frequently a volatility which is close to 100% and that does survive. Now, even the Lehman Brothers stock did not exhibit a 100% volatility during the last week of its life. So it's really one of its kind. You really have no idea of what is the risk of the Bitcoin until you own some of it. This is the bad news. Fortunately, we have a good news. The good news it is that investors are risk takers. Why do I say it this way? Because it simply does not make any rational sense to exclude the Bitcoin because of its risk. If you believe the Bitcoin is 3 times too risky for you, you simply invest 3 times less in it. The risk should never exclude or include an asset. Risk should only decide the size of the allocation. To illustrate what I'm saying, we have represented here the risk of $1 million invested in the S&P 500 in blue, and the risk of $25,000 invested in the Bitcoin in orange. So it's much less risky, in fact, to buy $25,000 of Bitcoin than to buy $1 million of the S&P. So the size of the risk should not exclude the Bitcoin from your portfolio. The size of the risk should only give you a clue of what is the size you want to include in your portfolio. So the rest of the presentation will consist into a short introduction to our investment thesis. What is our investment thesis? Our investment thesis on the Bitcoin, it is that the Bitcoin exhibits some fundamental characteristics and some empirical characteristics that provides it with the potential to become a new international standard measurement of value. I'm a mathematician, so I usually speak very precisely. What is the most important word I have used in this sentence? The most important word I have used in that sentence is the word potential. Now, it's very important to realize that I'm not saying the Bitcoin is a standard measurement of value. If it was already a standard measurement of value, every Bitcoin would probably be worth something like $2 million each. Whenever you talk about investments, you're talking about a potential. You're not talking about what is already realized. You don't buy a stock of Apple, a share of Apple, because it is $300, but you buy it because you believe it has the potential to go to $600. Whenever you invest, it is about something which is not realized yet. When it's already realized, it's already too late. This is the first word I wanted to elaborate. The second word I want to elaborate on is the word standard. What is a standard? It is what you need in order to measure anything. Whether you want to measure a length, a weight, a temperature, a quantity, you need a standard. This is a standard meter and a standard kilogram. What is the economy? The economy is a place in which you produce, exchange, store goods, services, labor, risks, innovation, contracts. And in order to produce, exchange, and store all of that, you need to be able to measure their values. And if you want to measure, you need a standard. For a lot of time, I used to say that if you want to understand the Bitcoin, you need to understand that the Bitcoin is simply gold in batter. It's only a couple of months ago that I realized that my statement was wrong. It's not the Bitcoin which is gold in batter. It is in fact gold, which is a Bitcoin in worst. Why am I saying that? Because the more I think about it, the more I think that the history of economics is about the quest for a better standard measurement of value. The first standard that we used were agricultural goods. When they were precious, when they were difficult to produce. Even today, you have still some Maasai tribes in Kenya that use number of cows in order to measure what are the values of things. Because of technology, it became easier to produce those agricultural goods, we went to precious metals. The first precious metal was probably iron. Then when iron became easy to produce, we went to brass, we went to silver, we went to gold. And somebody invented a new standard. He said, give me your gold, I will give you receipts. And when you give me back your receipts, I will give you back your gold. This guy invented the banknotes. And it's only twice in history that we had currencies that were not backed by real assets. Now, the second time that a currency became really a fiat currency, it is in 1971 when the US said, after all, we are the US and this is a dollar. We are going to stop for a temporary fashion and the convertibility of the dollar to gold. So first thing I would like to tell you, it is that really whatever question you have about the Bitcoin, except one question, we'll discuss this question later on. Whatever question you have about the Bitcoin, you simply need to replace the word Bitcoin by the term gold in the question in order to know the answer. We're going to elaborate on that a little bit later. So what are those fundamental characteristics that provide the Bitcoin in our minds with its potential to become a standard measurement of value? We have listed here 6 of them. The Bitcoin is non-alterable, it's non-forgeable, it is difficult to seize, it is not manipulated by a central authority, it is non-inflationary, and it is exchangeable. The 3 first characteristics are provided to the Bitcoin by the blockchain technology. What is the blockchain? The blockchain is an immense collection of safes. A gigantic number of safes. This is what the blockchain is. It's a planet of safes. In this immense collection of safes, every safe can be accessed 2 ways. Either you have the public key. If you have the public key, you will not be able to know how many Bitcoins there are in your safe. And you will be able to add some Bitcoins to the safe. If you have the private key, you will be able to open the door of the safe and you will be able to take those Bitcoins, in order to put them in another safe. This is what the blockchain is. In order for this planet to work, you need computation power. In order to access this computation power, you need to reward the computation power. And the inventor of the Bitcoin, an unknown guy called Satoshi Nakamoto, created a lottery in order to reward those who are providing the computation power to the blockchain. Those guys are called the miners. And the miners are rewarded by a lottery. Every 10 minutes, there is a lottery that takes place. And at the end of those 10 minutes, one of the miners will be allocated a fixed amount of Bitcoin, 6.5 Bitcoins currently. every 10 minutes. Now there is a lottery. And this fixed amount of 6.5 is divided by 2 every 4 years. This is called the halving. So you have a geometric series. And this geometric series converges into 21 million Bitcoin. So in total, there are exactly 21 million Bitcoins. 19 million of them have already been distributed during the past lotteries. And there are still about 2 of them that will be distributed between now and 2140. Okay. I told you that Satoshi Nakamoto is unknown, but I know his fathers. He has 2 fathers. The first father of Satoshi Nakamoto is Friedrich Hayek. Friedrich Hayek is a winner of the Nobel Prize of Economy. And his thesis, in a way, is to say that whenever a group of people is provided with the monopoly of money emission, of money issuance, he will one time or another abuse this monopoly. And he wrote a book about that, a book called Denationalization of Money, in which he said that we should stop the monopoly and allow free competition across hundreds of different currencies. So he says that whenever those group of people abuse their monopoly, it results systematically into very, very, very serious crisis. The second father of Satoshi Nakamoto is William of Ockham. William of Ockham is a British Franciscan monk who invented the razor of Ockham, the parsimony principle, a principle by which whenever you find a solution to any problem, you should try to simplify the solution. And Satoshi realized that there was a very complex thing into any kind of currency scheme, which is the management of the money supply. And imagine to simplify the management of the money supply and say the money supply will be fixed and constant once and for all. It is 21 million. Okay. And this is a major difference and the major addition of Satoshi Nakamoto to the idea of currencies, the fixed money supply. And this, in fact, resolves the problem of inflation. There are 2 causes of inflation. The first cause is that some goods become more difficult to produce. Imagine there is a climate change. Probably it could result into an inflation in the food chain, for instance, etc. But there is another cause for inflation. It is an inflation of the money supply, an increase of the money supply. Okay. And if you look at history, you will see that all the past standard measurement of value had suffered from that. The current standard measurement of value is the US dollar. During the 20th century, the money supply have increased by an average of 5.6% per annum. Since 2008, the money supply in US dollar has increased by 20% per annum. So it's an immense increase of the money supply. But you will tell me this did not result into an inflation. Yes, it did result into inflation. Because of course, inflation is not well calculated. Whether it is the cost of the states, whether it is the cost of housing, whether it is the cost of health, of education, in most countries of the world, this increase of cost is not taken into account, or is not at least well taken into account in the calculation of inflation. So there is already inflation, and there is already a relatively important inflation that is resulting from this increase of money supply. What is the ancestor of the US dollar? It is the Roman denarius. For centuries and centuries, every coin of denarius, the currency of the Roman Empire, used to include 4 grams of silver. It was a constant. Until suddenly one day, the Roman Empire said, we are the Roman Empire, after all, this is a denarius, and we are going to withdraw from the Bretton Woods agreements. And they have decided to begin including less and less silver in their coin. At the end of it, every coin was including only 0.1 gram of silver, and this resulting into an enormous inflation. I'm not putting any causality, but this coincides with the end of the Roman Empire. Gold itself is massively inflationary, in theory at least. And because of technology, we extract more and more gold from the gold mines. Every year, the output of the gold mines increased by about 2% per annum. And by the way, we have extracted from the core of the earth a total of 190,000 tons, roughly, since the beginning of humanity. There are, in fact, 10 to the power 15 tons of gold in the planet Earth, which means that for time being, we have extracted 0.0000003% of the total gold contained on planet Earth. There are lots of gold on planet Mars, on the moon. You will never find any Bitcoin on the planet Mars, on moon. Okay, this is why, theoretically speaking, the gold is not absolutely fundamentally coherent with its use as a standard measurement of value. Not to say that there are some pollution of its role by the fact it has also an industrial role, and it is well documented that in order for standard measurement of value to be effective, it needs to be only a standard measurement of value. Still, there are lots of criticism against the Bitcoin, and all of those criticisms are following the usual Kabler-Ross change curve. Whenever Kabler-Ross is somebody that did a lot of research on grief, on the phenomena of grief, on the different cycles of grief. And whenever there is a strong innovation, you need to grieve the old world. And during those moments of grieving, you will have anger and you will fight against the innovation. And this is what we are seeing today. So there are plenty of criticism against the Bitcoin. Some of them are driven by passion or ideology. Some of them are driven by ignorance or conflict of interest, but some of them are reasonable. You know, I've been wandering across around the Bitcoin for a few years, and I have never heard a reasonable criticism against the Bitcoin that will not find its answer in the development of a financial system between the risk takers and the blockchain. I really believe that any criticism that you have against the Bitcoin will find its answer in the development of a financial system between the risk takers and the blockchain. Before, you know, a few years ago, when I bought my first Bitcoins, there was no platforms. So the price of Bitcoin was unique, not unique across the planet. And everybody was criticizing the Bitcoin, saying its price is not even unique. And it is the development of a financial system that made it for the price of the Bitcoin to really become unique. What are those empirical characteristics that I was talking about? So the first of them, it is that the risk of the Bitcoin is very important, but its shape is completely normal. Whether you look at it on a daily basis or on a weekly basis, the shape of the risk of the Bitcoin is completely normal, which means that you can use classical risk management items in order to manage your risk in the Bitcoin. And this is very important. The second characteristic of the Bitcoin from an empirical point of view, which is very important in our mind, it is that the Bitcoin is a diversifying asset. It is probably one of the most diversifying assets you could imagine against any classical asset and against any alternative assets. It is much below the significancy levels against any kind of classical or alternative indices. In fact, there is no dependency between the Bitcoin and gold, S&P, the US dollars, and corporate bonds. Which means that adding 1% of the Bitcoin into a 60-40 portfolio will reduce the volatility of your portfolio, in fact, because of its diversifying level. As a conclusion, we are going to look at the last empirical characteristic of the Bitcoin, its liquidity. So I told you in 2016, I told my colleagues, the liquidity of the Bitcoin has enormously increased. Please pay attention to the fact that the scale is a logarithmic scale. It's a logarithmic scale. We are talking about basis points per $1 million, and it's a logarithmic scale. Okay? Which means that in 2016, the liquidity of the Bitcoin did increase a lot. But look at how much it has increased since then. Today, the Bitcoin is more liquid than LVMH, the largest market cap in Europe. It has roughly, it used to have in 2020, the liquidity of the ninth most liquid stock in the world. And 1 day out of 10 in 2020, the Bitcoin was more liquid than the stock Apple. So how to access the Bitcoin? In order to check how you want to access your Bitcoin, you should consider 3 main criteria: convenience, security, and efficiency. You should look at liquidity, correlation with the cryptocurrency, etc. And my small advice to you, it is to answer the question on how to access the Bitcoin using the trick I gave you in the beginning of the presentation, which was how to replace the term Bitcoin by the term gold. How would you access gold? You would certainly not buy bars of gold. You would not certainly store your gold in exchanges or buy a closed-ended fund or buy an exchange traded note or buy futures. What you would do is buy an open-ended fund. Because the magic of open-ended fund, it is that open-ended fund are consortiums between custodians, sub-custodians, auditors, and an asset manager and an administrator. And when those different actors are completely segregated, the fund will never file under, go on, never. There are no, even, Bernard Madoff, it is because of the confusion of parole between the asset manager and the custodian that those funds did, in fact, end up in a very bad fashion. Okay. So I have tried to summarize my presentation in 23 minutes exactly, which is the time I was allocated. So I cannot see whether I have some questions or not.
Oh, you do. Yves, that was superbly well timed. It's Stuart McDonald again. Yves, that was very interesting indeed. And thank you very much for that. We do have a number of questions, some of which have come in through the Q&A, others by other routes. I'll give you a couple to start with, and maybe start with one. One comes from Luis Pacheco, and this is one saying that the Bitcoin website says that Bitcoins can be divided up to 8 decimal places and potentially even smaller units if that is ever required in the future, as the average transaction size decreases. So, according to Louise, this means that even though there are a limited number of Bitcoins, they can be divided indefinitely. Now, the question is, doesn't that go against the inflation theory? Now, that's one question. Another one that's come through is, why only Bitcoin and not a more diversified portfolio of cryptocurrencies? Even if you can only cover those two briefly, I think that would be good.
So Louis is right. So every Bitcoin can be decimalized into 100 million Satoshis. This is exactly 8 decimals. It's 7 or 8. So it's 8 decimals. So every Bitcoin can be decimalized into 100 million Satoshis. Maybe later it would be more than that. But the fact that it is decimalized doesn't mean you increase the money supply. If suddenly we decide to decimalize more the dollar, if you have $2 before the decimalization, you still have $2 after the decimalization. It's simply the fact that you can cut the dollar into smaller pieces when the price of the Bitcoin, of the dollar, becomes too large. The first transaction that happened in the Bitcoin took place in 2010 when a guy bought 2 pizzas for 10,000 Bitcoins. That day, the decimalization of Bitcoin was not really useful. As of today, in 2021, 10,000 Bitcoin is worth $500 million, or 1/3 of $1 billion, to be more precise. No, almost $50 billion, $500 million. So now you need to decimalize the Bitcoin, but decimalization does not go, in fact, against the inflation theory, because the amount you have, every one of us, is not a change in proportion of the total money supply.
Understood. I think that's very well put, Yves. Thank you.
Why only Bitcoin and not a more diversified portfolio of cryptocurrencies? It depends what you intend to do with this portfolio. If the idea is simply to diversify your existing portfolio, given that the correlation of the Bitcoin is in fact zero with any constituent of a 40-60 portfolio, adding more cryptos to your crypto portfolio does not change. You will not go lower than an absolute value of zero. So in fact, from the point of view of diversification, when you look at your broad portfolio, adding as of today more than one crypto is in fact does not increase the diversification of your portfolio. Having a portfolio which is 100% Bitcoin or 50% Bitcoin and 50% Ethereum will not change the diversification of your total portfolio.
Okay.
Voilà.
That makes sense, Yves. And listen, thank you for being so interesting and making some pretty compelling points. Let me repeat that if anyone in the audience wants copies of either the presentations today, simply get in touch with Aaro or TOBAM afterwards. One other thing, again, if you have any questions for the next speaker, please put them into the chat section or the Q&A. Now, without further delay, and Yves, thank you very, very much for that. Let's hear from Ankush Jain, Aaro Capital's co-founder and chief investment officer, and he's going to be speaking about portfolio diversification beyond Bitcoin. Ankush, over to you.
Okay, thank you, Stuart, for the introduction. And that was a very interesting presentation, Yves, so thank you for joining us. I'm going to be following on from what Yves was discussing and talk about diversification opportunities beyond Bitcoin. And this is particularly important, given that there are now over 500 funds focused on this asset class. They focus on different things in different ways. Some focus just on Bitcoin, others focus on trading smaller crypto assets, others focus on the long-term story within blockchain itself. So there's quite a broad mix of approaches. And at Aaro, we believe that diversification is really very important to get the most out of an allocation to this asset class. So with that in mind, today we're going to be walking through some of the investment opportunities beyond Bitcoin, why it's important to consider DLT and crypto assets as part of an investment portfolio, the range of strategies on offer, and ultimately how to strike the right balance and make the most of diversified exposure within this asset class. So to kick things off, what is the opportunity set? Well, the opportunity set within crypto assets is quite broad. It includes cryptocurrencies, crypto commodities, and tokens. They all have their own incentive structures and use cases. And it's a space that is growing very rapidly. So, you've touched on the opportunity within Bitcoin, which has grown from practically nothing to over $700 billion over the last decade. There are many other crypto asset projects that are still fairly immature and volatile, and they allow for some short-term trading. But a selection of these are poised for some very strong and sustained long-term growth. So, for example, Ethereum is currently the leading smart contract platform with many different projects and decentralized applications built on top of it. Some of these are within decentralized finance, or DeFi. The DeFi space has grown from 1 billion to about 70 billion in the space of a year. So a huge amount of growth. And some of these use cases replicate traditional finance. So exchanges like SushiSwap, Uniswap, derivatives trading with synthetics, and DeFi insurance, Nexus Mutual. We've also seen non-fungible tokens, NFTs. Again, they've grown from practically nothing to 20 billion currently. And there's other interesting use cases in music, wireless networks. Helium's set up 50,000 hotspots worldwide. decentralized APIs, VPNs, and so on. So all of these create long-term value in some shape or form. This is just a subset of what is out there. And if we talk about some of the numbers compared to Bitcoin, Bitcoin so far this year is up around 20%, which is not too bad in the context of a traditional portfolio. But a lot of these other crypto asset projects are up hundreds, if not thousands of percent. So there is a really strong case for diversification beyond Bitcoin into other crypto assets here. And you've touched on the big word, potential. Part of our thesis at Aaro is to really tap into that potential, get behind the economics of crypto assets, understand how they're generating value, and ultimately select the funds which are best placed to capture these opportunities early on. But of course, it's not just about crypto assets. We all know the long-term picture for blockchain and other distributed ledger technologies, or DLT. It's expected that there's going to be $1 trillion worth of value to be created through the adoption of blockchain. And this will be across a large number of sectors, ranging from finance to healthcare and even art. And we're already seeing large governments and corporates use DLT to improve their core businesses. And of course, from the investor's point of view, this provides further opportunity. And to give a few examples of the kind of companies working on this, you have HSBC digitizing private placements of around 10 billion on a blockchain. UBS digitizing internal processes in terms of trade finance. JP Morgan using their JP Morgan coin for real-time transfer of payments, and they also have their own blockchain division called Onyx, which focuses on enterprise blockchain. You have Amazon with enterprise blockchain, Facebook with DM, the list goes on. And it's pretty much every day where we're seeing developments in this space and more companies moving into it. And as a reminder for those of you who attended our past webinars, and for those of you who are familiar with what we do at Aaro Capital, part of our thesis is being able to get in front of these developments before other people do, regardless of whether they are centralized or decentralized. Because alongside crypto assets, part of what makes DLT so powerful is the clear economic value that can be created. So we're really trying to understand which companies and sectors are employing this technology, where the value is generated and why, and ultimately find the best funds that can profit from these developments in a safe and sustainable way over the long term. And this brings us on to some of the key attractions of DLT and crypto assets. Over the past year, we've seen a real acceleration in the number and the prestige of institutions now getting involved. There are many reasons. We touched on the high potential upside, and also the fact that this is a fascinating technology way. But one of the key reasons is that this is an uncorrelated asset class. It's one of its key benefits for those wishing to diversify. And to put a few numbers to this, if you look at correlations relative to traditional asset classes over the last few years, it's virtually non-existent. It's ideal when it comes to diversification. You've got the high potential upside and a completely uncorrelated asset class. So similar to what Yves showed, we've done a bit of analysis here on where DLT and crypto assets fit in relative to a traditional portfolio. We've modeled equities, bonds, alternatives, and cash. And you can see here that even allocating just 5% of your portfolio to DLT and crypto assets substantially improves your returns, your Sharpe ratio, your Cetino ratio, and your maximum drawdown metrics. So really very good when it comes to diversification, particularly when valuations are looking stretched elsewhere. So a good opportunity. We've talked about diversification beyond Bitcoin into DLT crypto assets. We're talking about the benefits of diversifying to this asset class. But the real question for investors is how to gain exposure. And on our previous webinars, we talked about the benefits of an active approach. So right off the bat, you can see that active DLT and crypto asset funds have produced much better returns relative to Bitcoin. Since the beginning of 2017, funds have outperformed by over 4,500%. And much of that is due to downside risk protection. So, 2018, the market was down about 80%. Many of these funds were down maximum 20 to 40%, depending on which funds you chose. And if you really drill down into the details, this is where things start to get really, really interesting. So we've talked about diversification beyond Bitcoin, diversification into this asset class, but it is possible to even diversify within DLT and crypto asset funds, depending on your objective. So if we take a step back and think about the fund universe, we have identified over 500 funds focused on DLT and crypto. A lot of these are crypto asset hedge funds, which invest and directly trade in tokens, cryptocurrencies, or their derivatives. There's also a lot of DLT venture capital or private equity funds gaining exposure to early stage projects. Others are a hybrid of the two, which is quite unique to this market. They have liquid portfolios of crypto assets and tokens, and also side pocket portfolios of unlisted crypto assets and equities. And some funds are actually traditional funds, traditional equity and fixed income funds, with exposure to large companies focused on DLT. So some of the companies that we talked about earlier, they would fit in this bucket. So it's quite a broad range. And over the past few years, since our launch, we've developed our own methodology to categorize these funds into different strategies. So we largely look at things in three different areas. We look at non-directional strategies, trading strategies, and long-term strategies. And I can talk through each of these one by one. On the non-directional side, these focus on capturing some of those short-term inefficiencies in crypto assets, and they do it through arbitrage or opportunistic approaches. Arbitrage could be spot against spot, spot versus futures or options, or taking advantage of the demand for liquidity in this market. Opportunistic approaches are much more crypto specific, so engaging in lending, hedge to yield farming, staking or mining to generate some yield. And usually non-directional strategies focus on the most liquid crypto assets. However, there can be some event-driven trades that converge into the smaller ones. So generally speaking, these generate about 20 to 40% per year, pretty good Sharpe ratio, very shallow drawdowns. Looking at the numbers, and by the way, this is an index that we put together of non-directional funds. If you look at the numbers, on average, the return is about 30%, low volatility, a very impressive Sharpe ratio, minimal maximum drawdowns, and largely positive months. So very good during weaker market environments, and certainly a good diversifier within a balanced investment portfolio. On the trading side, these tend to focus more on capturing some of the upside of crypto asset markets whilst hedging against the short-term volatility. So they can have either high exposure to the market, low exposure to the market. They can be systematic, discretionary, or a combination of all of those different areas. So some of the typical strategies that we see typically are trend following, mean reversion, relative value, but the approaches can vary quite widely. Some funds focus on-chain metrics, others on sentiment, some even try and trade the volatility in the market. And again, these tend to focus on the top 10 or 20 crypto assets due to their liquidity. In terms of returns, and again, we've got some similar analysis here based on an index of DLT and crypto funds. The returns are much higher than non-directional funds, quite impressive, capturing the upside. Some muted volatility relative to the market. The market volatility would be around double of this. A lower Sharpe, but still pretty good. A muted maximum drawdown relative to the market. So again, the market would have dropped 80% in 2018. These dropped 20 to 30%. And a balance in terms of positive and negative months. So quite a good offset to some of the non-directional strategies we talked about earlier. On the long-term side, you can split this into active and passive. We focus on the active side because of the opportunities out there. This includes fundamental thesis-driven investing into tokens and public and private equities. And this can also include special situation trades, of which there are many in this market, as well as unhedged yield enhancing trades. So again, focused on yield farming, staking, mining, using options to generate some income. The strategies here tend to be a bit more adventurous. So investing well beyond the top 100 crypto assets, looking at public market equities, early stage unlisted tokens and equities. So again, very broad. And if you look at the numbers again, they tend to offer the largest amount of the upside, but also with a higher volatility. So a slightly lower Sharpe, a more pronounced maximum drawdown, but ultimately the greatest returns. You could see the large rise over the past year in these strategies. So that's quite a high level overview, but you can see here just the sheer range of strategies available in the DLT and crypto asset space. They all offer different things in terms of risk and reward. Non-directional funds, low risk, low return, high Sharpe. Long-term funds, high risk, high reward, a lower Sharpe, and trading in between. And again, that's illustrated on this chart here. Over the past few years, we've talked to hundreds of funds within these different areas. It is our view that the best way to approach this market is to diversify, to focus on all three of these different areas, and also to do enough due diligence on funds to ensure that you're selecting the right ones, because there is a great deal of dispersion. Many funds within these different areas would be vastly outperforming, many would be underperforming. But generally speaking, there is a very powerful opportunity presented by diversification here across these different areas. And if you think about how this fits in investment portfolio, really you'd be looking to rotate between these different areas. So depending on whether the market is bullish or bearish, you'd want to rotate from non-directional to long-term, or long-term to non-directional, depending on your focus, and to maximize your risk-adjusted returns, regardless of where you are in the market cycle. And that's precisely what we do at Aaro with our own portfolio. So to finish up, we've covered quite a bit on this topic. The key point I'd like to emphasize is that there are many different types of diversification in this market. You can diversify beyond Bitcoin into other crypto assets and into the whole technology, the whole DLT story. There are also many diversification opportunities, even in terms of funds and the strategies they offer. And ultimately, diversification, like Yves mentioned, is a very strong case for allocating to this asset class. So I just wanted to end on this quote by the master himself, Harry Markowitz. A long time ago, he talked about diversification being the only free lunch in finance. And I think it's safe to say that diversification is one of many free lunches in DLT and crypto assets. So on that note, I'd like to thank you all for listening. I'll hand it back to Stuart, and happy to answer any questions that you may have.
Well, thank you very much for that, Ankush. Yeah, we've got a few questions for you. One that's come through the Q&A from an anonymous attendee. It's simply this. I mean, which of these strategies that you've spoken of, be they non-directional, trading, long-term, do you think is going to perform the best?
So really, it depends on the market conditions. As shown here, each of these strategies respond in different ways, depending on their risk and reward profiles. So in a bear market or a mean reverting market, you'd expect the non-directional funds or the lower beta trading funds to do very well and to generate returns regardless of how the market moves. In a bull market, you'd expect the higher beta trading and the long-term funds to do the best and to capture most of the upside. But given that all of these have different characteristics, it is important to have exposure to all three areas and to rotate between them depending on where you think the market is going. So really, it's not just about which strategy is going to perform the best or the worst. It's also about being nimble enough to capture the trends and to profit when the market is going up and protect when the market is going down.
Okay, Ankush, How should you, as it were, weight these different strategies in an investment portfolio?
Yeah, so, I mean...
And I'll just say you have time for a reasonably detailed answer.
Okay, yeah, sure. I mean, usually when you think of asset allocation or portfolio management, you think in terms of a strategic asset allocation. So in a multi-asset portfolio, you'd have a set weight towards equities, bonds, property, other alternative asset classes. And then depending on where you are in the market cycle, you'd have tactical weights around them. So you'd overweight equities or underweight bonds or vice versa. And it can be as granular or as high level as you want. So similar to that kind of logic, at Aaro, we've put together some long-term strategic weights to these three different areas and also their subcomponents. The key aim is to capture the long-term trends, protect on the way down, and that's reflected in those weights. In the short term, depending on how bullish or bearish we are, we'll overweight things or underweight things. So to give you an example, over the past year, our indicators have been quite bullish. As such, we weighted long-term and trading strategies much higher than non-directional. So between these two, they accounted for 80 to 85% of our portfolio, and non-directional about 15 to 20%. That proved to work quite well for us when the market went up. But of course, the market sentiment and market direction can change. So as we approach perhaps towards the end of this bull run, whatever that might be, we'll then think about rotating from long-term trading to directional and adjust our weights accordingly. So I think to answer your question, it's important to have long-term views, long-term weights to each of these different areas. But again, depending on whether the market is bullish or bearish, what the short-term view is, being overweight or underweight them on the prevailing market view.
Okay. Now you've talked about bullish and bearish, and I'm going to put this question both to you and to Yves, if you will, because this is an interesting question. I mean, how do you identify if this market, if things in this space are bullish or bearish? And again, you have plenty of time to address this. And I wonder if, Ankush, you would pick this up, and then maybe I can ask Yves if he has a view on this as well. Ankush?
Yep. So to identify if this market is bullish or bearish, we've done quite a bit of analysis internally. So we work with our economic advisors. Peter, the chief executive, he specializes in that aspect of things, so he works quite closely with them. We have our own methods to identify the trends, and we looked at different indicators. So we looked at technical indicators, which are perhaps a bit more useful in the short term, not so much in the long term to make long-term decisions. We've looked at sentiment indicators, again, not so useful when you're in the middle of a cycle, perhaps more useful when the market is either at the peak of a bull run or at the bottom of a bear market, where fear and greed is much more real. Of course, to have an overall view on the macroeconomy, so to understand the wider context of things, understand where things fit in relative to traditional markets. But for us, perhaps the most, the single most important factor for us is looking at the network. So this market is quite unique. You can quite easily track the size and direction of flows flows happening on the blockchain, and it provides some kind of indication of whether the market is overvalued or undervalued, similar to a PE ratio in traditional markets. So to give you the example of Bitcoin, you can look at network value to transaction values, how miners are getting compensated for mining Bitcoin, where the money is flowing between exchanges, and those give a pretty good picture, not just in the short term, but medium to long term, whether we are in a bull or a bear market. So, of course, I mean, you need to consider different factors altogether, sentiment, technicals, whether we are in a bubble or not, and the network and so on. But for us, the most important way to identify whether we're in a bull or a bear market is to look at the underlying networks.
Okay, thanks, Ankush. Yves, are you still there? I wonder if you would care to address that question. How would you identify if this market is bullish or bearish?
I have two answers. First of all, I fully agree with what he just said, Ankush said. I would add two answers. First of all, you don't need to be bullish or bearish in order to want to increase your diversification. So using the Bitcoin as a way to increase your diversification is something you should always do. Whether you're bullish or bearish, try simply to increase your diversification. The second answer is more is different. You know, I had a meeting with the CEO of one of the largest hedge funds in the US a couple of weeks ago. They are considering putting a very large amount in the Bitcoin, and they wanted to meet with some, people across the world to speak about that. And the CEO, I was honored to have a call by him and for him to discuss with me the thing. And towards the end of the discussion, he was pretty much convinced, but he told me, but I still have two small things I don't understand about the Bitcoin. And I stayed silent for 5 seconds. I told him, you have two things you don't understand about the Bitcoin. I told him, on my side, I don't think I understand anything anymore about the dollar and the euro. I don't know whether you need to be bullish and bearish on the Bitcoin. I wonder whether the question you should ask yourself is, what is it that you understand still about the dollar and the euro when you realize that the money supply has increased by an average of 20% per annum since 2008? I think you don't need to be bullish or bearish about the Bitcoin. The Bitcoin investment thesis is to try to manage the way central bankers are dealing with the money supply. And you have two alternatives for the Bitcoin, not three of them. The first alternative scenario for the Bitcoin is that central bankers become orthodox again. I guess most of us will agree that it's unlikely. And the second adverse scenario on the Bitcoin, it is that we find something better than the Bitcoin. And given the simplicity of what the Bitcoin is, I believe it's very unlikely that we find something that is even simpler than the Bitcoin. And in my mind, this is what really makes the case of the Bitcoin. Thank you.
Well, Yves, thank you very much for that. Now, a question on everyone's lips, everyone who's in any way engaged with this space is, just going forward, what do you, the point is well made about diversification considerations perhaps being of greater significance than whether one is per se bullish or bearish. But, going forward very quickly, Yves, do you have a view as to where the market is going for the rest of the year and into next? And then over to you, Ankush.
So I answered in a way this in the chat. My perspective, it is that on the medium term, I am relatively bullish on the price of the Bitcoin. I am bearish on its volatility. I believe that its volatility is going to decrease. And both of the price and the volatility are driven by the same driver, which is adoption. I think the adoption will increase progressively. And the higher the adoption, the higher the price, and the lower the volatility. I think I am relatively stable on correlation. I really believe that if the Bitcoin is not adopted, the correlation will stay close to zero. And the more the Bitcoin is adopted, the more it will be a safe haven. It will be considered. The ipso facto condition for adoption is that the Bitcoin is considered a safe haven. And the more it is considered a safe haven, the more it is adopted, and the less its correlation will increase. Whenever you will fear the S&P, whenever you fear the other assets, you will go to the Bitcoin. And this is going to contribute for the correlation of the Bitcoin to stay low. So those are my three.
Thank you very much. Ankush, we've got less than a minute left, but I just wonder your view going forward for the rest of the year into next.
So we're still very optimistic. Our indicators are still bullish, and we've backtested them across different bull and bear market cycles. The fundamentals still remain intact. There has been some cooling off over the past month or so with some weakness, but if you look at what's happening in the market, large banks like Bank of America, Credit Suisse, and more are still getting engaged and working on the space, and also at the levels of adoption, there's a huge amount of interest, and we expect this to continue. Okay,
that's fantastic. Listen, both of you, Yves, Ankush, that was really, really good, and not only interesting, but very timely, very compelling. Listen, attendees, a record of today's webinar will be circulated, and please look out for news of Aaro Capital's Next Thought Leadership webinar. And I know that Aaro Capital extend their thanks collectively to Yves and the rest of TOBAM for participation in today's webinar. Till the next time, everyone, take care. A pleasure.
Goodbye. Thank you very much.
Thank you.